QXO trades at roughly $17 today. Wall Street sets the average target at 31.50 cents. That represents a massive 94% upside. Yet, the company lost $227 million last quarter alone. This one stock is the ultimate Wall Street battleground. Analysts predict near 100% upside for a money-losing operation. This setup is pure, undeniable audacity. The answer lies strictly with Chairman Brad Jacobs. He boasts a historic 300x return track record. Investors are betting blindly on this one single man. They trust him to build a $50 billion empire. But look closely at the underlying $3 billion of debt. Massive, dangerous leverage hides in plain sight today. We are talking about immense structural dilution risk. That specific risk ties to 200,000 shares of Series C preferred equity. It acts as a heavy trapdoor for common stockholders. We will expose that exact math in about 10 minutes. You need to understand this risk before buying one single share. First, we must deconstruct the underlying machine itself. Let's explore exactly how Jacobs builds a $50 billion giant. The global building products distribution industry generates $800 billion annually. It is massively fragmented across 7,000 different North American distributors. Imagine 7,000 different mom-and-pop shops fighting for market share. They all pay vastly different wholesale prices to suppliers. This chaos is exactly what QXO wants to fix. Macroeconomic tailwinds are incredibly fierce right now. The U.S. housing market is effectively broken today. We are exactly 4 million units short of basic demand. That creates a guaranteed 8-year backlog at current build rates. The demand for these 7,000 distributors is essentially bulletproof. Furthermore, the average American home is over 40 years old. Old homes constantly drive relentless repair and remodeling demand. Non-residential structures average over 50 years old across the country. Add another $2 trillion in necessary federal infrastructure spending, the demand side is structurally locked in for 2 solid decades. This fragmented supply chain is ripe for a tech-enabled consolidation. Scale is truly the only way to win this game. You cannot analyze QXO without analyzing the one operator behind it. This is the classic 4-step Brad Jacobs playbook. Step 1 targets a boring, highly fragmented sector. Step 2 raises massive institutional capital. Step 3 involves acquiring high-quality regional platforms. Step 4 implements cutting-edge technology and slashes redundant costs. Jacobs executed this exact sequence at United Waste and United Rentals. Let's look closely at the 2015 XPO acquisitions. He bought 2 massive companies named Norbert Dentressingle and Conway. Management doubled the profit of both companies in just 3 years. That execution speed is absolutely breathtaking. Between 2016 and 2022, they generated over $4 billion in net cash. If you rolled your money sequentially through his public ventures, you won big. You earned a life-changing 300x return on your initial investment. This 300x track record is the entire bull thesis. Investors are betting heavily that the playbook works one more time. Now let's carefully examine the year-over-year financial shockwave. Legacy revenue in 2024 was just $56.9 million. By 2025, post-acquisition revenue exploded to $6.84 billion. Let's walk through the first quarter financials step by step. Total revenue hit a massive $1.73 billion. The prior year was a mere $13.5 million. This instantly shifts QXO's entire financial profile overnight. But scale absolutely did not bring immediate profit. The first quarter net loss was a painful $227 million. Earnings per share was incredibly negative at 35 cents. Adjusted EBITDA was a razor-thin $1.2 million. Let's look at the balance sheet right now. Cash sits comfortably at $3.05 billion. However, long-term debt matches it exactly at $3.06 billion. Why is there exactly zero actual profit yet? Because buying corporate giants requires immense cash up front. QXO spent $74.8 billion on Beacon transaction costs alone. Revenue buys you initial market share immediately. Margin optimization always comes 1 or 2 years later. Let's look at the 2 foundational anchor deals. First, let's look at Beacon Roofing Supply. This massive transaction closed in April 2025. The total valuation was an astonishing $10.6 billion. They paid a hefty 10.8x EBITDA multiple. Beacon brings $930 million in legacy adjusted EBITDA. Beacon operates a highly centralized commercial roofing model. Next, look closely at Kodiak Building Partners. This specific deal closed in April 2026. The final price tag was exactly $2.25 billion. It was funded with $2.0 billion in hard cash. It also notably included 13.2 million newly issued shares. QXO retains the right to repurchase those shares at $40 each. Kodiak operates a strictly decentralized local model. They locally supply 3 main items: lumber, doors, and windows. Integrating one centralized national roofer with one decentralized supplier is incredibly hard. They operate on two entirely different structural models. Integrating them simultaneously is a massive operational headache. What does a tech-enabled distributor actually mean in real life? It means brutally stripping out 100% of analog inefficiencies. Management specifically plans to double legacy Beacon's EBITDA organically. They intend to expand margins by over 500 basis points. In an industry fighting for pennies, a 5% boost is astronomical. How do they actually achieve this 5% boost? They use AI-driven demand forecasting across 7,000 potential targets. Imagine knowing exactly what one specific zip code needs today. You know they need 10,000 pallets of shingles right before hurricane season. You are not randomly guessing your inventory anymore. They also deploy centralized algorithmic procurement. They leverage massive volume to demand far deeper vendor discounts. They increase the span of control and fire redundant middle management. Building products is fundamentally a high-volume, low-margin game. That 500 basis point margin expansion radically transforms the underlying cash flow. Technology provides the mechanical lever they pull to get there. We must dramatically shift our analytical framework right now. Stop using standard DCF models immediately. Traditional discounted cash flow models fail 100% of the time here. Why is it the wrong tool for the job? Because QXO currently operates with deeply negative free cash flow. A DCF mathematically requires positive cash flow to function properly. Furthermore, there is zero historical operating data at this consolidated scale. The intrinsic value of QXO depends entirely on deals not yet made. It depends heavily on a $100 billion future target pipeline. Therefore, as an analyst, you must pivot your framework. You must apply forward enterprise value to EBITDA multiples instead. You must actively use pro forma combined target figures. We need to compare QXO to three highly profitable, scaled peers. Look closely at Watsco, Ferguson, and Core & Main. These three companies trade at massive premium multiples today. That is the only valid way to price a newly consolidated roll-up. Enter the single most massive catalyst for this one stock. The impending TopBuild acquisition changes the entire game. This is a monumental $17 billion transaction. It massively expands QXO's total addressable market to over $300 billion. More importantly, it secures absolute, undeniable market dominance. QXO instantly becomes the #1 player in insulation. It becomes the #1 player in global waterproofing. But here is one truly surprising fact you might have missed. It pushes the combined company directly into complex data center infrastructure. Modern AI data centers require massive, specialized cooling and insulation setups. This brilliant move connects a boring building products company to the AI narrative. The deal is fully expected to close in the third quarter. It fundamentally alters the entire long-term trajectory of the stock. It turns a large roll-up into an undisputed industry titan overnight. Let's anchor these massive numbers to reality right now. Look closely at TopBuild's staggering 2030 financial projections. The combined revenue for this new entity will easily exceed $18 billion. TopBuild alone targets $9.5 billion in revenue by 2030. They also target an impressive $1.85 billion in adjusted EBITDA. The business operates a highly efficient, remarkably capital-light model. Management confidently estimates massive cumulative free cash flow over the next 4 years. They clearly project $4.2 billion to $5 billion between 2026 and 2030. Contrast that with QXO's current negative cash position. This new free cash flow is literally the lifeblood of the entire machine. Without this specific cash from TopBuild, the massive debt load crushes them. This $4.2 billion specifically services the heavy debt from previous deals. It completely funds the ongoing expensive integration costs. It also heavily fuels the next wave of strategic acquisitions. How do you possibly justify a $17 billion acquisition price tag? The answer is 100% flawless synergy execution. Management actively plans to extract $300 million in run rate EBITDA synergies. They expect to hit this $300 million target by 2030. Let's break down exactly what cross-selling means here. Imagine one massive national home builder starting a new neighborhood. Right now, they call 3 different local guys for supplies. They call one for the roof, one for drywall, and one for insulation. After this merger, they make exactly one phone call to QXO. That creates massive operational efficiency. They will aggressively bring together vast distribution networks with deep installer capabilities. Massive scale directly drives immense procurement efficiencies. Better centralized buying power significantly lowers the core cost of goods sold. Field-level operational excellence physically reduces warehouse overhead. This aggressive synergy extraction actively mitigates the terrifying integration execution risk. This represents the ultimate 10-year endgame. Do not mistake QXO for a quick 3-month momentum trade. It is a systematic, highly calculated industrial roll-up. Management is actively targeting a vast shortlist of potential M&A candidates. That specific pipeline represents a staggering $100 billion in combined target revenue. The strategy remains brutally simple. They will buy, optimize, generate cash, and repeat. The ultimate financial goal here is truly immense. They are aggressively targeting $50 billion in annual revenue. They plan to hit this target within one single decade. They are simultaneously targeting $7.5 billion in adjusted EBITDA. Think about the sheer scale of that massive ambition. They are trying to build a global titan entirely from scratch. If they actually hit those staggering numbers, the stock is historically cheap. You are mathematically forced to believe in the specific $50 billion outcome. Let's deeply connect those $50 billion targets to executive incentives. As an investor, you desperately want management to eat their own cooking. The senior leadership team and the board own roughly 36% of QXO equity. That 36% represents massive inside skin in the game. But you must look much closer at the actual payout hurdles. 2/3 of the CEO and CFO equity compensation is performance-based. It is tied directly to total shareholder return. There is absolutely zero payout unless QXO beats the 55th percentile. They must actively beat the 55th percentile of the S&P 500. Management does not get a single dime of their bonus otherwise. They are mathematically forced to care deeply about the stock price. Furthermore, there are incredibly strict lockups in place. All restricted executive shares cannot be sold or transferred until January 2030. They quite literally only win if the common stockholder wins big first. Now we must explicitly reveal the massive hidden risk I teased earlier. Pay incredibly close attention to this specific capital structure. On April 1, 2026, QXO quietly issued Series C preferred stock. They specifically issued 200,000 shares. They raised exactly $2.0 billion in cash to fund the Kodiak deal. Each preferred share carries a massive $10,000 liquidation preference. If the company goes bankrupt, they get paid first. The Series C holders take their money before you see a single penny. Investors also committed to purchasing another 100,000 shares for $1.0 billion. This represents immensely heavy structural dilution risk to the common equity. This preferred equity legally sits high above your common stock. Here is the incredibly dangerous math. It specifically converts at a benchmark near $23.25. Buying at $17 means that conversion level acts like a heavy ceiling. It limits your upside if their operational execution falters even slightly. We must aggressively lay out the real 3-part bear case right now. First, the structural execution risk is truly unprecedented. QXO is attempting to roll up over $30 billion of deals simultaneously. Integrating 7,000 diverse, fragmented targets is an absolute operational minefield. Federal antitrust scrutiny on the TopBuild merger is a massive risk. In the true bear case, integration fails completely. Heavy preferred dilution and heavy debt overwhelm the operating cash flow. The stock easily plummets below $10. Now, consider the moderate base case. Assume moderate integration success with standard, cyclical macroeconomic housing softness. Regional competitors fight back in local markets. In this base case, the stock likely stagnates right here around $17 to $20. Finally, the explosive bull case entirely requires flawless execution. The $17 billion TopBuild deal must close smoothly. If Jacobs hits his massive synergy targets, the stock definitely soars. Let's summarize the final verdict for focused value investors. The pure bull case points directly to Brad Jacobs' historic track record. It boldly assumes absolutely flawless execution of the 300x return playbook. It models a clean trajectory to $50 billion in annual revenue. That flawless scenario heavily justifies the massive $31.50 price target. Conversely, the strict bear case heavily demands extreme caution. It loudly highlights the heavy preferred equity dilution overhang. It fears the chaotic risk of simultaneous integration failure across 7,000 targets. It aggressively prices in cyclical housing market softness and federal antitrust blocks. The explosive 94% upside here is undeniably and highly conditional. It depends entirely on flawless, near-perfect integration execution by the management team. The underlying spread between a 300x upside and a debt-crushing collapse is massive. The numbers are on the screen. The decision is yours.